Business Credit Scoring 101. Your business has its own credit profile and score linked to your business EIN number. 3 main business reporting agencies provide your business credit profile and score: Dun & Bradstreet, Experian, and Equifax Commercial. A business credit score is a mathematical model that is used to depict a business's risk of going 90 days late on an account within the next 12 months, while consumer scores depict risk over a 24-month time frame. A business credit score reflects the business's likelihood of defaulting on an obligation, not the business owner's. The business credit score is based on how the business obligations are paid, not how the business owners pays their personal obligations. Each reporting agency provides access to multiple business credit scores that evaluate different forms of risk. FICO also provides its own business credit score to assess business risk, and banks have their own internal bank credit score that's used to determine business loan approval. These scores are used by credit issuers, lenders, suppliers, vendors, and others who typically extend credit to businesses. Yes, your business credit scores are used each and every time you apply for credit and financing for your business. But lenders and credit issuers will not tell you this, nor tell you which scores they're using to assess your business. There is no Fair Credit Reporting Act in the business world that requires them to do so, as there is in the consumer credit world. It's also important to note that your business credit profile and scores are available to anyone who wants them. In the consumer world, someone needs your permission to pull your consumer reports, something the FCRA calls permissible purpose. But there is no FCRA in the business world, so anyone who wants your reports can easily and cheaply get them, including competitors, prospects, clients, lenders, and more. Dun & Bradstreet's credit scores. Dun & Bradstreet provides 2 performance credit scores. D&B's performance scores reflect a company's past performance using only information within the D&B database. D&B's 2 core performance scores are Paydex score, D&B rating. The Paydex score indicates how a company has paid its bills over the last 24 months. The D&B rating indicates a company's net worth range based on the company financial statements as well as a company's overall condition. The most popular credit score used in the business world is known as a Paydex score, provided by Dun & Bradstreet. From D&B, the D&B Paydex score is D&B's unique dollar-weighted numerical indicator of how a firm paid its bills over the past year, based on trade experiences reported to D&B by various vendors. Dollar-weighted means that D&B gives more weight to accounts with higher limits than ones with lower limits. Paydex gives more weight to the trade accounts that report higher amounts of credit extended and less weight to trade accounts that are reporting lower dollar amounts of credit. How a firm paid its bills over the past year means this score is based on past performance as the main driver. It's simply based on how you paid your bills. The score ranges from 1 to 100. Higher scores are lower risk as they predict better payment performance. Any score of 70 and higher, D&B defines as a good score. An 80 score reflects prompt payment. A score of 70 reflects payments are paid within 15 days of terms. Scores 50 or lower represent payments being made 30 or more days past terms. A business can obtain a Good Business Paydex credit score by ensuring payments are made promptly to suppliers and vendors. Here's a breakdown of what your Paydex score literally means. A perfect score of 100 indicates that payments may come early. A score of 80 is considered good because it means you pay your bills promptly on time. If you pay your bills an average of 30 days late, D&B will give you a 50 score. And a 20 score means you pay your business bills 120 days late on average. A business will need a Paydex score of 70 to 80 to obtain the most favorable financing. To obtain a Paydex score, a business will need at least 3 trade accounts reporting to their file. It can take 30 to 90 days for those trades to report and a score to be established. The business credit score itself is calculated by using as many as 875 payments. True definition from D&B. D&B rating is a performance score based on a company's net worth from its financial statements, as well as an overall credit assessment using information in D&B's database. The D&B rating indicates a company's net worth range based on company financial statements, as well as a company's overall financial condition. If a company's financial statements are not provided, the score is based on company size, industry, or other related factors. The D&B rating is a performance score that's based on a company's net worth and overall credit assessment. The D&B rating is broken into 3 distinct categories. Category is assigned based on the amount of information available on a company. There are 3 categories for the D&B rating. Category 1 is the traditional D&B rating. Category 2 is the expanded credit appraisal. Category 3 are alternative ratings. Category 1. Traditional D&B rating reflects net worth or equity. D&B calculates this based on the company's financial statements and payment experiences. Both must be in the report to qualify for the traditional D&B rating. Even if you have payment experiences, if no financials are present, there will be no traditional D&B rating. This score also includes the Composite Credit Appraisal Score. Composite Credit Appraisal Score reflects an overall assessment of credit worthiness based on company payments and financial stability. If financials are not available for a company, the company falls into the Expanded Credit Appraisal category, based on the total number of employees for the business. If financials nor company size is available, D&B gives a score in the 3rd category, the Alternative Ratings category, based on the amount of information available in the company's report. D&B's predictive scores predict a company's expected performance over the next year or 12-month time period. D&B provides 3 predictive scores: D&B Delinquency Predictor Score, Financial Stress Score, Supplier Evaluation Risk Rating. The D&B Delinquency Predictor Score predicts whether a business will pay its bills on time. The Financial Stress Score predicts the chance that a business will experience financial distress. The Supplier Evaluation Risk Rating predicts whether a business will stop delivering its goods and services. EXPERIAN'S Business Credit Scores. The second most popular credit score in the business world is the Experian INTELLISCORE. Experian's most recent score system is known as INTELLISCORE Plus, which they boast of as the next level in credit scoring. INTELLISCORE Plus takes into account hundreds of variables to offer a business score between 0 to 100, with 100 being the highest. INTELLISCORE predicts a business's risk of going seriously delinquent or over 91 days late, or having a major financial issue such as a bankruptcy within the next 12 months. The new INTELLISCORE Plus has over 800 aggregates or factors that affect the credit scores. Experian first takes a business and looks at data segments such as firmographics, public records, collections, and trade information, then places each business in one of 3 different models. INTELLISCORE is one of the only business scores that offers a blender score. The blended owner model blends both commercial data and the owner's consumer information. Because this score blends with consumer data, this is one of the only scores that someone needs your permission to pull. Studies showed that when trouble hit a business, blended scores dropped an average of 30% over the 4 quarters leading up to the bad event. Their consumer scores of the owner showed no statistically significant decline over the same period. The score evaluates the personal information on the owner as it relates to business performance. Experian says their research data indicates that 53% of problems for a business revealed their first signs of credit problems on the business credit reports. 46% of problems first showed up on the owner's personal report. Blended scores outperform consumer or business alone by 10 to 20%. INTELLISCORE Plus, just like FICO, has multiple facets to the entire score makeup. There are 5 different components that make up the INTELLISCORE. Historical behavior accounts for 5 to 10% of your total score. Age, industry, and company size account for 5 to 10% of your score. Your credit utilization accounts for 10 to 15% of your score. Your derogatory items account for 10 to 15% of your score. And your payments and balances account for 50 to 60% of your overall score. Scores are based on a number of factors contained in your business credit report: number of trade experiences, outstanding balances, payment habits, credit utilization, trends over time, public record recency, frequency, and dollar amount, and demographics such as years on file, standard industrial classification codes, and business size. The INTELLISCORE is calculated by a statistically derived algorithm designed to determine risk based on multiple factors: credit, number of trade experiences, balances outstanding, payment habits, credit utilization, and trends over time, public records, recency, frequency, and dollar amounts associated with liens, judgments, or bankruptcies, demographic information, years on file, standard industrial classification or SIC code, and business size. Experian also offers a financial stability risk score. This score predicts the potential of a business going bankrupt or defaulting on its obligations. FSR scores range from 1 to 100. They are broken down into 5 risk classes, with Class 1 being the lower risk. On this graph, you can see a breakdown of Experian's financial stability risk score and the odds of someone paying as agreed versus defaulting. EQUIFAX'S business credit scores. EQUIFAX'S main business credit scoring model is the credit risk score. This score was created to predict the probability of a business customer becoming seriously delinquent 90 days late within a 12-month period. Credit scores range from 1 to 100, with a lower score indicating a higher risk of serious delinquency. Similar to the D&B PREDICTIVE score, the credit risk score is based on payment history. All that's required for a good score is to pay business obligations as agreed. The earlier payments are made, the higher the score will be. If your bills report is paid as agreed, you'll earn a score of 90 or higher. If you pay 1 to 30 days overdue, your score will be 80 to 89. If you pay 31 to 60 days overdue, your score will be 60 to 79. If you pay 61 to 90 days overdue, your score will be 40 to 59. If you pay 91 to 120 days overdue, your score will be 20 to 39. And if you pay 120 days or more overdue, your score will be 1 to 19. Equifax also provides a business credit score for suppliers, known as the Small Business Credit Risk Score for Suppliers. This model is designed to help credit grantors improve their risk assessment and reduce delinquency rates while helping to improve profitability. The score utilizes unique bank loans, lease information, credit card data, and supplier, telco, and utility credit history, public records, and firmographic data from their own Equifax commercial database. The Small Business Credit Risk Score for Suppliers credit scores range from 101 to 816. Experian also offers several other popular scores that are used by suppliers, lenders, vendors, and credit issuers. The Credit Risk Score predicts the likelihood of a business incurring a 90-day severe delinquency or charge-off over the next 12 months. The Business Failure Score predicts the likelihood of a business failure through either formal or informal bankruptcy over the next 12 months. The Payment Index provides a dollar-weighted index of a business's current and past payment performance based on all payment experiences in the Equifax commercial database. Equifax also offers a Business Failure Risk Score with many reports. This risk score predicts the likelihood that the business will fail or file for bankruptcy within the next 12-month period. This model helps identify businesses that pose a greater risk for failure so that suppliers and credit grantors can take appropriate actions. FICO's Business Credit Score. The FICO SBSS score is a measure of your small business's credit worthiness. This score is becoming very popular with lenders. This score has also become widely used by SBA to qualify business loans. It's based on both your personal and your business credit history, not just your business as the main business scores do now. The SBSS was actually launched all the way back in 1993. Since SBA started using it to evaluate all 7 A loans under $350,000 in 2014, it's now become even more popular. Scores reflect the likelihood of the applicant paying their bills timely. Scores range from 0 to 300. Higher scores mean lower risk, so the higher score you have, the better. Personal and business credit history, as well as financial data, are used for the total score calculation. As of 2014, all SBA 7A loans must go through a business credit score pre-screen. For SBA loans, you won't be approved with a score below 140, but they typically set the cutoff as high as 160. Below that, you'll probably be denied because of being too high a risk. Actually, chances are good the SBA lender won't even submit your application to SBA if your score doesn't meet this threshold. Many factors are taken into account to calculate the FICO SBSS score. Some include the owner or co-owner's personal credit information, business credit history, age of the business, years in business, financial data including assets. Other score factors include cash flow, revenue, the last 12 months of paydex scores from D&B, liens, judgments, any other known financial data. If you have no business credit history and limited time in business, the highest possible FICO SBSS score you can get is 140. But even to get that high of a score, you'd have to have pristine personal credit if no business credit is established. SBSS models are validated for term loans, lines of credit, and commercial cards all the way up to $1 million. This helps credit issuers making evaluations for larger transactions. If you are applying for bank financing of $1 million or below, chances are good that your SBSS score is being evaluated. SBSS gives small business credit issuers different combinations of data to evaluate the risk of a business. For example, a credit issuer can choose to only evaluate the application data of the principal owner, or they can choose to also include data from one or more of the business bureaus, or they can choose to weight one aspect higher than the other. This is a highly intelligent score because it automatically goes from one business bureau to another in whatever order or priority the credit issuer chooses to generate a score. So if a lender prefers the D&B paydex score as the default, the SBSS pulls that data set. If there isn't enough info to generate a score, it then automatically checks another business score, such as the EXPERIAN'S INTELLISCORE, or it can even move on to the EQUIFAX'S commercial data. Contact us today to learn more.